Hi there, I'm Nicole Bryson, Education Specialist and Account Manager at the Partners Group, and I'm here today to talk about market volatility, particularly how it impacts our retirement plan accounts. So what exactly is market volatility? Essentially, it's the ups and downs that we see in market values. And when the stock market and the bond market are experiencing significant shifts and fluctuations in prices, that's what we consider to be market volatility. And then the wider and the more frequent that those shifts and fluctuations are, the more volatile the market is. Aggressive investments, those tend to be more volatile, so more sensitive to both market highs and market lows, while conservative investments tend to be the opposite, less volatile, meaning less sensitive to both those highs and lows in the market. So what should we do as investors when we experience market volatility? It can be very uncomfortable, especially to experience market downturns, because along with the market going down, we'll probably see our retirement plan account balance go down as well. The main key to remember here, though, is not to panic. Don't panic. Happily, there are absolutely things we can do, steps we can take to navigate market volatility smartly. So the first thing I want everybody to keep in mind is that market fluctuations merely mean that the value of our investment holdings has changed. Unless we sell our investments during a market downturn, we haven't actually incurred or realized a loss. So let's go through some tips that will help us weather the storm. Tip number one, keep a long-term perspective. So stay the course with your investments. Saving for retirement is a long-term investment strategy. Do not try to time the market, meaning don't try to predict when the market might go up or down and sell in and out of investments accordingly. That can actually be fairly risky and cause harm to portfolio performance. Also, we want to try to avoid being emotional about our investment decisions or too reactionary in response to market fluctuations. Remember those long-term goals. Stay invested for the long haul versus paying attention and reacting to what's happening in the short term within the investment markets. Statistics do show us typically that staying the course rather than selling in and out of different investments, staying the course is often the wiser long-term choice for investors. And one common mistake that we see is when the market goes down, somebody's account balance might go down, they feel nervous, they sell out of their investment to avoid losing more. And then when the market goes back up, they might buy back in, become an active investor again. And this is essentially selling low and buying high, which really is the opposite of what we should be doing as investors to maximize our portfolio returns. When we talk about a long-term perspective, I don't have a crystal ball for market performance, but we can look back at historical performance in the markets. So this chart here has data for just over 40 years. There's a vertical line for every year, starting in 1980 on the left, and it goes all the way over on the right to 2022 year to date as of the end of the first quarter. And the red dots at the bottom show the intra-year low, meaning the lowest point the market hit during that year. And then the dark gray bar, that shows where the market closed out the year. So end of the day, December 31st. And we can take a couple things away from this chart. The first one being that every single year here, the market had at least some form of rebound, meaning that it closed the year higher than that intra-year low point. And then about 3/4 of the time, the market closed the year in positive territory overall. So try to remember that what's happening today or this month, this year in the market, it's kind of a snapshot in time or a flash in the pan of the full life of our retirement investments. And actually over this 40+ year time period, the average annual rate of return was positive 9.4%. So I like to think of this for a visual as I'm doing a yo-yo. It's going up, it's going down, just like we see in this chart here. There's certainly ups and downs, but then I'm slowly, simultaneously doing the yo-yo, I'm slowly walking up a flight of stairs. So I have these bumps up and down along the way, but my longer term trend is that slow positive trend, the 9.4% average annual rate of return here in that example. Tip number 2, keep contributing during market downturns. This is a really important one because it's the silver lining. This is the positive part of the market downturn. When the market goes down, it is an excellent time to be a buyer because the market is essentially on sale. The values are lower. So if I am, for example, saving 10% each pay period into my retirement account, my same 10% in a market downturn, that will be able to buy more shares of those same investments while they're valued lower. And then when the market eventually rebounds and goes back up, I will just have more shares of those investments, all increasing in value simultaneously to help my portfolio rebound as the market rebounds. Tip number 3, review your investment portfolio. So it's really important to know how you're invested and understand how you're invested. And a couple things to keep in consideration when you're reviewing that is your personal risk tolerance and your time horizon to retirement. So make sure that your investment portfolio lines up with these two things. Your time horizon for retirement is just how much time you have left between now and retirement. And then your personal risk tolerance is just how much you can stomach ups and downs in the market, because we're all individuals in that regard. Diversify your portfolio. So we have all heard the term, don't put all your eggs in one basket. And that's really what we're talking about here when it comes to diversification, meaning your asset allocation or your mix of investments should have exposure to different types of investments, or as we call them, asset classes. And then this diversification helps to essentially spread out your risk among those different asset classes. Rebalance your portfolio. So a rebalancer will periodically adjust your portfolio allocation, again, your investment mix. It will periodically adjust it back to your original investment strategy, that original investment mix that you had set. And when it does this, when the rebalancer runs periodically, it's attempting to buy low and sell high. So it will sell off some of the shares that have appreciated, so the investments that have increased in value, and then buy some of the ones that are at lower valuations. And then regular rebalancing over a period of time may increase the overall return of your portfolio performance. Most often, the 401k plan record keeper website, so that's where we go to log into our 401k accounts. Many of those offer an automatic rebalancer feature that you can just go log into your account and activate on your own. So check out your 401k online account and see if that's a feature that's available to you. If anybody listening is invested in a target date fund will take care of diversification and rebalancing on its own without you having to take any action. Tip number 4, speak to a financial professional. So get help when you need it. Don't be shy about asking for help or talking to an expert when you need a little bit of guidance. That's what they're there for. So consider speaking to a financial advisor or a financial planner and just talk about your investments, talk about your goals for your investments, and about the market in general. You may already have access to speak with a 401k plan advisor through your 401k plan or retirement plan at your employer. A lot of plans offer this service. The plans that we work with at the Partners Group offer this service. So check in with your human resources department and see if that's a feature of your plan. Quick recap here. Let's just recover the tips for weathering the storm of market volatility. Number 1, keep that long-term perspective in mind and stay the course with your investments. Tip number 2, keep contributing during market downturns. Take advantage of the silver lining and buy those investments while they're on sale. Tip number 3, review your investment portfolio. Know how you're invested, make sure that it's in line with your goals and your individual situation. And then number 4, speak to a financial professional and just get help when you need it, because there are resources and there's help out there for everyone. Thank you so much for your time today. Again, my name is Nicole Bryson with the Partners Group. Bye.